Hey, welcome everybody back to the Presidio Perspective. Dustin TenBroeck here. We're recording this on Cinco De Mayo, May 5th. So we're going to talk about what's going on in the market. A lot of ups, a lot of downs. Pals come out. Whenever you're watching this, I'm sure it's going to be a lot different the way that the market's going. So who knows? Hopefully it's all green for you over there on the other side. But anyway, got a good show for you today. Let's get it going. All right, Jeff Anderson in the studio with me today. You look a little stressed, Jeff. So, wow, man, we've had some big moves over the last couple of days. So again, yesterday, May the 4th be with you. Here's Cinco de Mayo. Whenever people are getting this, probably over the weekend here. But what a week of movements in the stock market and bond markets to digest. And so I'm sure there's a lot on people's minds, and hopefully we can bring our perspective to what's going on.
Probably a lot of confusion.
Yeah, well, so let's try to clear that up. So it's all about the Fed, right?
Right.
So what happened?
So they met yesterday and they raised rates by 50 basis points, which was what the consensus was. But, people wonder in the middle of the day, in the morning, the market was down. All of a sudden, Powell comes out, raises it 50 basis points, has his commentary, and then the market went crazy.
Yeah, so
to the upside.
We should set the backdrop, right? I mean, the market's ripped at the end of the day yesterday, right? Waiting for those comments. The comments came out. Everyone's saying, is it going to be 75 basis points, right? We were quoting statistics before. Some people were saying it's a 90% chance, 75% chance, 35, whatever. There's something priced in about a 75 bip increase, and it came to 50, right? Which is like, okay, well, that was definitely priced in and a little bit more. So, the markets go up, and then you're like, okay, are we through this? Did we set a new trajectory? And you came in and you checked your stock account or your stock app today, and you're like, nope, right back down, and then some. Right. So, I mean, that's really confusing when those things happen. Like, how does a market rip one day and go down just as much, if not more, the next? How within, and really it was at the end of the trading day yesterday and the beginning of the trading day today. So within an hour of trading, you had that about a 7% reversal, a 7% move, right? 3.5 up, 3.5 down. How does that happen?
Traders.
Yeah.
Positioned short the S&P coming into the Fed rate meeting, playing for a 75 basis point hike, which would be a surprise, which would send the market down. It didn't happen. So what do? They cover that short, and it sends the stock market higher.
Because so they have to start buying the stock market because they didn't get the short. They promised to sell the stocks they don't own at a certain price. They have to go out and buy them, and forces the market up.
Yeah, and I guess their feeling would be a trader would look at something like that and say, okay, well, if the Fed surprised everybody and raised by 75 basis points, we think the market could go down 5% and just continue.
Yeah.
And if it doesn't, maybe it goes up 1% or 2% and we can cover. So they always look at a risk-reward trade. And I think that short covering kind of got everybody in there, and people thought maybe the worst is behind us. And they kind of, traders jumped in, and then everybody digested that overnight, and then they came right back out and started shorting it again.
They move their shorts a day.
Yeah.
Yeah. And so then you see that. So yeah, a lot of this is trading. So, well, we'll come back to that. Let's keep talking about what happened to the Fed. Okay. So, so there's two things, right? There's raising the federal funds rate, right? Which is making money cost more money, right? Kind of helps tamper down inflation, right? It's going to kind of bring the valuations of prices of things down, right? So if interest rates are higher, what people can afford to pay or what they're willing to pay is going to come down. You think of that of just like a house. If you have a higher, 6% mortgage rate versus a 3% mortgage rate, how much of house can you afford with the same amount of income?
Right.
And same thing is in the stock market. If money's cheap and free, you're willing to buy stocks and for a long payoff in the future. Well, if money's costing you 3%, 4%, 5%, you're going to need to get some cash flow from your investments.
I think one of the might help is I think a lot of people, we throw around the word inflation and we talk about it all the time, but what does it really mean? In simplistic terms, I think one good way to look at it is too much money chasing too few goods or services, right?
Yep. My stepdad always says that. He's like, there's the definition of inflation. Yeah, exactly.
So before COVID happened, the Fed's balance sheet was something like $4 trillion. Now we're going to raise rates, and we'll talk about how they're going to reduce that balance sheet. We're at $9 trillion.
Yeah.
Right. There's only a certain amount of goods we can produce, and that's been affected by supply chain shortages. We still have lockdowns in China. We haven't resolved the supply chain issue, so the amount of goods available to us is below normal. And then we've got a ton of cash out there. So we've got low interest rates, a ton of cash, and limited goods. So what does that do? That has a lot of people competing for those goods, which drives prices up. You can go into the components of CPI, and it's right out there in front of you.
Yeah.
And so that's simply what it is. I mean, we talk about inflation being, just losing purchasing power, but it's simply that. I mean, think about it. If you and I both want a pair of shoes and we got a bunch of money, that pair of shoes isn't going to go for $120. It might go for $500 because we really want them. We both have a lot of money. That's kind of inflationary, and that's what's happening.
Well, yeah. And so the interest rates, right? So it's a good point. So it's like, well, for investments, like assets that you're buying, whether you're financing, and that financing cost goes up, that risk-free rate goes up, then it's like, okay, I'm willing to pay less of a multiple for that stock, right? I got to have more earnings, have those earnings come sooner, not so far out in the future. Same thing with my bonds, right? So prices go down, yields go up. Same thing with real estate. So you see an increased interest rates, it's causing the price of things to come down, and it's sucking money out of the economy too, because if your cash is actually earning some interest, you're less likely to go, and it's going to cost you some pain to go buy those shoes at double the price.
Right.
Because you're actually not only losing out on the money, but you're losing out on the interest that money is compounding and earning for you when you have an interest rate. Right. So this is what we're trying to do, slowing down the economy to get inflation under control. And the Fed has come out, what is the term that you said earlier? It's the Jerome
Volker.
Yeah.
Was the title of one of our
Volker.
providers' first trust came out there. That caught my attention. I thought that was great. And we talked about this before. I mean, we talked about what was different about Powell versus Bernanke versus Yellen versus Greenspan. Not that they didn't do a good job, but there was a lot of criticism, but they were academics. And Volker is more, he really understands the markets. And
so Powell, are you talking
Powell,
about?
I'm sorry.
You getting them confused now? That's pretty
confused. There's been so many of them. But
yeah, so Volker's who ended inflation in the 80s after we had rampant, inflation in the 70s.
Yeah,
stagflation, right? And so they kind of fixed the markets, right? Some short-term pain for long-term gain, which is really important for investors to remember. Before we get on the historical study, let's just talk about what happened. So we had a 50 basis point raise, because I want people to really understand, why is this market flipping out, right?
Right.
Because there's some big things here. 50 basis point raise, which the market had a little bit more priced in. So we kind of everyone knew at least that was coming, right? I will tell you, historically, it's interesting. People are preparing for this interest rate raise, and you're like, I've seen this happen before. When the Fed doesn't do it, it actually sells off worse. Because why would the Fed not raise rates? Because they don't think the economy is healthy enough to withstand it. And so when they increase rates by 50 basis points, long-term investors are also they're not selling, because they know this is short-term trading, and they know that we still have a healthy economy and we can bear it. Again, we're getting off of the allowance that mom and dad have been providing. But anyway, it's the largest move since May of 2000. Right. So it's been a while since we've seen a move like this. Anytime you reflect like, this is the largest since 2007, since 2000, like your hairs go back on the back of your neck, right? But anyway, so they also came out, Fed Chairman Powell said, okay, so the next two meetings on the table, 50 basis points each, bringing us to a 2.5% federal funds rate by the end of the year. End of the year.
Which is not a lot.
Especially if inflation's 8.
Yeah.
I mean, it's still well below
got a lot of work
inflation,
to do.
right? And so that's not so crazy. And then when asked, about a 75 basis point move, he said it's not something they are actively considering, which I think is also calming for the long-term investors, right? And so there's this methodical approach. They're going to keep raising rates, looking for a 2.5%, and having that bring down inflation. So it was a switch from, what'd you say before, transitory to
expeditious.
Yeah, to expeditious.
And again, that's from our friends over at First Trust.
Yeah.
I thought that was a good headline.
Okay. So federal funds rate is one thing. Then maybe you can help explain the other part of this, which is the balance sheet reduction. So we talked a little bit about what rising rates do to to tamper down inflation, brings prices lower. And we'll kind of talk about what opportunities that sets up for investors, as I'm sure everybody wants to know. But so what does shrinking the balance sheet mean? What are they doing? Because they've come out with some guidance on that as well.
So we want to talk about the plumbing, do we? Yeah. So we're certainly familiar with what quantitative easing is and money printing. We've talked about that. Everybody's read about it. And we talk again, $4 trillion balance sheet went ballooned to $9 trillion to kind of stem deflation. We were talking about deflation in 2020, which is the enemy of even more than inflation.
Right.
The Fed really, because deflation is even worse. Because what is deflation? It's the fear. If you think something's going to be cheaper tomorrow, you won't buy it today.
Correct.
And that just freezes everything up. And asset prices go down. It challenges collateral levels, and it's a cascading negative feedback loop. Mm-hmm. So the Fed printed a bunch of money, handed them out, dropped them out of helicopters, and we had a balance sheet that went to $9 trillion. But how did they do that? So they get cash from the Treasury. So the mint prints the money digitally. And then what do? They go out there and they buy treasuries. They go out there and they buy mortgage-backed securities from the banks. So what do the banks get? They deliver them the bonds. They get the cash.
Banks get the cash.
They get the cash.
And then they have that money to lend out and inject in the economy.
Right. And then we got to a point during COVID where the Fed was actually going out there and buying corporate bonds.
Well, and also it's important to understand, remember supply and demand. So when you have a balance sheet going from 4 to 5 trillion, right? And you have all of this demand for debt, right? I'm going to buy mortgages. I'm going to buy bonds. What does that mean? More demand, price goes up, right? And bonds have an inverse relationship, price and interest rates.
Right.
So as the Fed's buying bonds, they're sending bond prices higher, driving interest rates lower, right?
To stimulate the economy.
And so it's two ways that they're going to move the interest rate, right? So this is more the long end of the curve too, right? Because now instead of just raising the federal funds rate, the overnight lending that banks have to pay to each other is now we're going to set the market for the long dated 30-year bonds, 20-year bonds, 10-year treasuries, right?
Right. And so they call that yield curve control.
Yeah.
So what are we doing?
Important.
Right. So what are we doing now? Rates are going up and then reducing the balance sheet by, was it 45 billion and then moving up to 90 billion a month by the end of the year?
47 and a half and then doubling to 95.
Right. And
so June 1, 47 and a half. 30 billion of treasuries, 17 and a half of mortgage-backed securities.
Right.
And then they're going to double those numbers incrementally, 95, 60, 35.
Right.
For total and treasury and mortgage-backed securities. So now they're selling.
Right.
And
so they're removing liquidity.
Well, they're removing supply, or they're adding supply. So supply and demand, they're saying here's a bunch of supply, drives prices lower. What does that do? Bond prices go down, interest rates go up.
Right.
Right.
But that money that, so part of it too is letting bonds that they hold mature and then returning the cash to the Treasury.
So
right?
Shrinking the demand in that case.
Right. Well, and that's just taking away liquidity. So we had a huge liquidity rush, and now we're trying to take that liquidity out. So even at 90 billion a month times 12 is a little over $1 trillion, right?
Yeah. $1.80
trillion or whatever it is.
Yeah.
Trillion here, trillion there. We're talking about real money at some point.
You mean 95 over 12 months?
Yeah.
It's 1.14 trillion. I did the math for you earlier.
Oh, thank you.
So, which is important to note, right? So it's about 1% of the total balance sheet per month.
Right.
So even if you're reducing it by $1 trillion, remember they increased it by $5 trillion, overnight.
Right.
And we're talking about an 18-month period where they might reduce it by $1 trillion.
Right.
So it's some headway. I think it's important for the future of the country and so forth that we have, the ability to have those tools and arsenals, and the Fed has those tools and arsenals that they're going to need in the future. So the other thing, again, this is making, back to my analogy, mom and dad stronger. They're always going to be able to help out. And so if we do need help in the future, this is perfect building up back that arsenal for the Fed of what we need. But they still say unemployment's all-time low, wages are increasing, asset prices are still high, inflation's waging, economy's strong. We can handle this. Short-term pain.
Right.
Yeah. It's a big delta though if you think of where we were September of last year. I think you told me earlier is the 90 billion we were actually buying,
Right.
and now we're going to be selling 95 billion. So it's like a 180 billion swing, which is a pretty significant change on a monthly basis of money going in or money coming out.
Yeah, it sure is.
Yeah. So, so anyway, and then when asked, Russia-Ukraine impact, China slowing economy impact, Chairman Powell and the Fed are like, nope, not even a consideration. We're going to get inflation under control.
Right.
Yeah.
And when we talk about inflation and still the idea of changing the tune from transitory to expeditious, meaning we're going to tackle this right now, the expectations for inflation that we're running at like 8.5%, right?
Mm-hmm.
And there are three things that really drive inflation. It's the monetary base, the money that's been printed, too much money out there chasing too few goods. And then we have the geopolitical issue with Russia and the Ukraine and oil prices. That's a big component. Energy is a big component of the CPI. And then the other one is the supply chain. And the supply chain is not completely fixed yet because we still have lockdowns in China. And they're dealing with their own recessionary pressures. But I think Powell, from all the stuff that I've read, he's looking at inflation not being at 8.5% next year, maybe being in the lines of 4 or 5%.
Yeah, that's what we've seen.
Yeah. So if you get 4 or 5% and then you bring up the Fed funds rate up to 2.5%, 3%, then your real rates are only negative 2%, right? Which is still accommodative.
Very much. Yeah.
So the markets don't like uncertainty. They don't like taking away the punch bowl, but they will adjust.
Well, some of it's the markets and some of it's traders, right? I think that a lot of times, like, you just have to separate these two. And so for us investors that are making investment decisions today for the long run, these are unfortunate parts of the market that we have to endure and as investors.
Right.
And we talk about it day one that anybody ever gets introduced to you or me or the firm: inflation, taxes, market crashes. Right? And we talk about those three things and their juggernauts. And doing the wrong thing at the wrong time will destroy your wealth when dealing with inflation, taxes, market crashes.
Yeah.
And everything in our financial DNA is going to scream at us to do the exact wrong thing at the wrong time. I'm going to pay off my super low rate mortgage because Dave Ramsey told me to. And I don't know that money in the future is worth less.
Right.
And now we've been telling people that for years, and look at what's happening with inflation and how where interest rates are. And oh my gosh, would that been nice to have that 30-year mortgage right now versus that 15, and so how we deal with inflation. And then, the markets, there's times like this in investing, and we all know it, and one of the things that we do with our clients, right, is a risk tolerance assessment. Right. Of course, there's a lot of study and time horizons and understanding what their income liabilities are, mathematically calculating everything in their portfolio. But, it's interesting how much risk somebody wants to take is equal to how much reward that they're hoping to make. And a lot of people are more aggressive investors in a bull market.
Right. And that's an important part.
Yeah. And then
component, really.
And then that means you're going to endure massive drawdowns during these times because you're investing for the things that have the most potential reward.
And in a 5-year bull market, it's easy to say that you have the tolerance for risk until it happens.
Yeah, absolutely.
Right.
And so those investors, you don't get to change your risk tolerance questionnaire because the market's down.
Right.
People are like, no, never mind. I'm conservative. Essentially, I'm going to buy high and sell low. No. You set the strategy, right? Maybe you'll learn next time. And hopefully you worked with somebody that counseled you on what the upside and downside was, and you were able to understand, and you had a plan that you had some long time horizon. Just hopefully some people do that out there. But so here it is. We set these 10, 15-year time horizons on our equities, and we're like, okay, yeah, I'm going to hopefully for long-term growth. And I set up this strategy so that I can endure markets like these. And I think it's just, the wrong thing to get in there right now. Like, if you're an investor, if you're a trader, you're active, you're doing things right now, and you're winning, you're losing, whatever, if you're an investor, this is the time you turn off the news, you don't check your app, you don't look at your statement today, you get a drink of water and go for a walk and focus on some other points of life, right? We're not bending on the end of the world.
Right.
The U.S. economy is super strong.
Right.
Technology revolution is still in its infancy. There is a massive, young generation of population of people who are entrepreneurial, smart, and better educated than any generation before. Put your entitlement stuff aside, right? I mean, they are poised and ready to buy a bunch of stuff in the future. The future looks really good, especially for America. And so just times like this, it's like, sit back, don't start messing with your portfolio. This is not the time. And if anything, what should we do in times like these?
Nothing.
Or even better.
Or even buy.
Yeah, right? I mean,
if you're fully invested and you have a plan and you're invested, that's where I say you don't do anything. You don't panic.
Sure.
Maybe it causes a rebalance in the portfolio depending on certain conditions.
Right.
If you have excess capital, that's a time to put it to work. Definitely. I mean, we talk about it all the time, and I sound like the biggest cheerleader of Warren Buffett, but we talked about this.
You are
many times. He spent $40 billion of their hard-earned cash in the first quarter.
Yeah, we're all conditioned to do this, right? When the markets kind of go down, or whatever we're investing in, right? If you bought a home and you sold it and then it went up, or you bought it and it went down, whatever it is. And we just look in the rear view way too much as investors, and that's what we can do, and you're like, shoulda, coulda, woulda, because you evaluated a bunch of data 12 months ago. And you're like, okay, here's the case for this happening, or this happening, or this happening, and here's some probability analysis or whatever, and whatever you did. You go, man, shoulda, coulda, woulda, I should have sold out at the high, right? Then I'd probably be buying right back in right now. Like, no, you absolutely wouldn't have done that.
No.
I knew, we met some folks over the year 2019 and 2020 who were like, oh, I went to cash, I in 2019 or something like that, It's like, oh, cool. Did you buy in at the low during COVID? No. Well, so you're down even today pretty significantly if you made that move, right? So getting out is the easy part, and then getting back in is just, it's gut wrenching, nauseating.
It is.
If that's you. You want to avoid that at all costs. But so the shoulda, coulda, wouldas, I try to encourage people, don't think about what you shoulda, coulda, woulda done 9, 12 months ago. Think about what are the shoulda, woulda, couldas that you're going to say to yourself 9 or 12 months from today, and spend your energy and your research and your conversations focusing on that, And I tell you, I mean,
I'd be a lot more productive.
Yeah, exactly. Right. And if you look back at the historical averages, and we've shown the slides and we've shown all the data, we have all the data, and every time, this time's different. But I mean, every time, you look back and the market sells off 20, 30%, and you look what it's worth a year later, 2 years later, 5 years later, outside of some other unforeseen event happening, you did very well buying when the market goes down. You didn't do well if you sold.
Right.
I mean, the research is out there. I mean, every time, we looked at this. Here's how often the market goes down 10, 20, 30%. What is that market on average, going to be worth a year and 2 years from now? What's that rate of return? Maybe we can get up a slide here to show that on this podcast, because it's really interesting, right? Or maybe we'll post something on the YouTube. But I mean, when you look at that data, it gives you, say, okay, what is the statistical probability 9 to 12 months from now? I go, man, I should have sold everything when the market went down. I mean, how often has that happened? I can't even think of a time.
Well, the one thing that we can draw on history is, again, history is our guide. We always talk about it. It doesn't repeat, but it often rhymes. But the stock market is upward sloping.
Yeah.
Over time, betting on the end of the world will drive you into bankruptcy.
Yeah.
But behaviorally, you talk about that buying high and selling low. But I think it's important that we have to remember something is we are engineered to feel loss 2 times more than we feel gain.
The equivalent gain, yes. There's statistics on that, on investor behavior and psychology. I've seen that before. Yeah.
And so when times like this,
so when you're up 10, you're gonna have half the exuberance as you do when it's
you'd need $20 of gain to feel equal to $10 of loss.
Yeah, right.
And so I think that's very important to to keep in mind. So,
I mean, it's interesting, those are kind of questions that we ask when we kind of do risk tolerance assessments. And again, I mean, it's like, okay, here it is, this is what's happening, but lots of reward on the other side. I mean, if we just kind of take a look right now and you're looking at the market, I mean, it's a wonderful time to buy into a balanced portfolio. I mean, stock multiples are lower. Stocks are on sale. They're cheap. The price to earnings multiples have come down dramatically. I mean, to some of these, you just can't even believe. You just, if I told you 9 months ago that these companies were selling at these prices, you would have been hoarding cash, just like, oh, I'm going to buy hand over fist. But people don't do that when it goes down. Everyone wants to buy the dip, like, oh, I wish it would dip. And then the dip happens and they're like, frozen, I don't want to buy, right? Or I want to even sell, But stocks are cheap and bonds are paying interest.
Right.
I mean, we're actually getting income from our bond portfolios. We're getting some yield that we can cycle back to buy those stocks at lower prices.
Right.
The dividend yields have gone up on our, I know you smile on that, but it is relative to the value of equities that we hold. The actual amount of cash that we're bringing in is going to allow us to buy more shares of those companies per dividend. We're buying more shares now on a dividend reinvestment strategy than we were 9 months ago. Company buybacks, I bet you're going to see some crazy buybacks this year. I don't know, maybe we can kind of have some forecasts and have an over-under bet going, but these companies that have cash flow and their stocks are down, I mean, this is a time to return money to shareholders in a tax efficient way by buying their stocks. And I bet you the market rewards that significantly. I mean, there's going to be, what are they not rewarding? Companies that don't make money, companies that, have a promise of maybe making money at some point in the future.
Right. And they all have these types of markets. I think we need to kind of put these things into perspective. And you could look at some of these tech names that are down, some darlings of COVID, not just the stay-at-home companies, but some of them are down 70, 80%. And some of the companies that represent the top 10 holdings in NASDAQ in 2000 were down 80%.
Yeah. And, I mean,
there are two types of companies that go down 80. They all go down at the when you have a real bear market, everything gets sold off, right?
Okay.
The quality ones rebound, and the other ones that don't have enough cash go bankrupt.
I was going to say that. I was talking to this owner of an RAA, very successful practice out in Nevada this morning, and we are just commentating on the markets together, sharing perspectives. And he was like, there's just a lot of good companies, just getting beat up, going down right now. I'm like, well, there's a lot of bad companies out there going down. And, my dad told me that at an early age too, explaining recessions to me. And he's like, look, they have to happen. There are companies that are out there that should not be out there. There are companies that are making money that shouldn't be making money, right? They're offering, something that doesn't exist, right? It's a dream, it's a pitch deck,
right.
Or they're just bad operating companies and somebody should do it better. And when
right.
money's cheap and the Fed has the fire hose out and demand is strong and money's flowing around, like all of these things just get propped up and they're nothing, right? So sometimes you need these bear markets to just level that playing field. And so a lot of times that's happening, but you got a lot of opportunities in these companies that are going to make it and be very strong and more robust at these times, right? They're looking for buying back their stock. There's going to be more mergers and acquisitions. So a lot of opportunities are created in markets like these, and it's just time for investors to be leaning in on their investments and not coming out, right?
Good investors make a lot of their money, most of their money in bear markets.
And
bad ones lose all their money.
Yeah, exactly. Hey, one thing I just wanted to talk about too, because you said that you were getting some questions from folks saying, hey, we're going into a recession, isn't it time to get out? And oh my gosh, COVID was such a great lesson for everybody. It wasn't that long ago. Just go back 2 years and just remember what you were experiencing when the market went down before you even really knew anything, right?
Yep.
And then once the more information you had about how bad it really was, the market was just taking off. And just like, remember that, right? People are like, oh, there could be bad times ahead. The market could go down. It's gone down, right? Yep. So again, what's priced into the future? like you're not going to be smarter than this market. You got to be that long-term investor. We're going to have multiple recessions over a 15-year period on average, right? If you're investing for the long run, you're not trying to pick recessions ups and downs. If you looked at the last couple of ones, I guarantee you would have got it wrong, and you would have lost a truckload of money if you just versus holding versus buying more when it goes down, right?
A healthy economy drives the market, but the market leads the economy, and I think that's really, really, really important.
Yeah, it's a separation of the two.
Yeah, but you're absolutely right. It's like by the time you've come to your conclusion,
yeah,
the market's it came to it 6 months ago.
Yeah.
And right, COVID is such a great example. And as we get further and further away, I think it's important that you and I continue to remind clients that.
Yeah, and look, I mean, this is just part of investing, and it's a painful part of investing. We never want our investments to go down. But when we are investing in volatile priced assets, right, which is essentially everything except for cash, which is losing 8% guaranteed, right? I mean, you're going to experience times like this, and you just got to hold on through to the other side, right? I mean, do not bet on the end of the world. The future, the long-term growth, it's bright. Mathematically, you've calculated your portfolio. You know you're okay. You don't need to sell. Don't do anything. What I say, don't do anything foolish or something like that. I gotta get a better closing line, Sierra. Don't do anything silly. I think that's what I said.
Don't be silly.
Don't be silly. Oh man. Well, anyway, so I think it's just really time for investors to remember their long-term strategy. Get a review of your plan. Know what the long-term commitments that you put out. You knew that you were going to go through ups and downs, and you're not going to be smarter than this market, right? And so, yeah, are we going to see recessions? Sure. Are we going to see increased interest rates? Yes. Inflation? Yes. Taxes? Yes. I mean, these are things that we have to navigate and deal with, right? But that's just part of the experience. And on the other side, there's a lot of opportunity.
Yeah, well said.
All right, guys. Well, again, we'll see you next time here at the Presidio Perspective. Jeff and I are going to go get to work. All right. Bye.